Earlier this month, JP Morgan published a report analyzing the crypto market in the United States. This is significant because JP Morgan is the largest US bank and has historically been very skeptical of crypto. Not only that, but US investors continue to be the largest contributors to the crypto market. As such, the findings in JP Morgan's report could shed light on what will happen in the crypto market in 2023. So today I'm going to summarize JP Morgan's crypto report, explain what it says in simple terms, and tell you exactly what it could mean for the crypto market in the coming year. You cannot miss this one, folks. Before I dig into JP Morgan's report, I want to give you a quick bit of background about the megabank's relationship with crypto. As some of you will know, JP Morgan's CEO Jamie Dimon is famous for being anti-crypto, and he's been vocal in his opposition since crypto went mainstream in 2017. However, JP Morgan, the bank, has been a bit more balanced, especially during the current crypto cycle. It all began in February 2020 when JPM was reportedly considering merging its blockchain arm with Ethereum builder Consensus. The bank has had conflicting views of crypto ever since. For example, in May 2020, it recommended that its clients stay away from crypto. Shortly afterwards, it announced that it would be providing banking services for Coinbase and Gemini. Now, this is surprising given that JPM has also allegedly unbanked many crypto entities. For context, it reportedly closed a bank account of a crypto mining company in August 2021 and infamously closed the bank account of Uniswap founder Hayden Adams with no explanation. There has since been speculation that the order to close Hayden's account came from the US government. In any case, in February 2021, JPM said it did not expect companies to add BTC to their balance sheets, like Tesla famously did. Just 2 days later, JPM's co-president admitted that the megabank will get into Bitcoin, quote, at some point. Now, if that wasn't hypocritical enough, JPM also said that BTC was no longer a hedge due to its increased correlation with the stock market. 1 week later, JPM sent a letter to clients recommending they allocate 1% of their portfolios to BTC as a hedge. Throughout 2020 and 2021, JPM was also frequently comparing BTC to gold. 1 month, its analysts would say that investors preferred BTC to gold, and another month they would say that investors preferred gold to BTC. Never mind that BTC being lumped in with gold technically makes it a hedge asset. Now, for what it's worth, JPM apparently still believes BTC will hit 150k in the long term, a prediction which assumes BTC will compete with gold. Jamie, who has acknowledged that BTC could yet 10x, still says he will not invest. He also called cryptocurrencies, quote, decentralized Ponzi schemes earlier this year. Now, despite the megabank's bipolar opinion of crypto, the fact of the matter is that it has been investing in the industry and adopting it. Consider that it led an investment in Consensus in April 2021, entered the metaverse earlier this year, and made its first DeFi trade on Polygon just last month. Then, on the 13th of December, JP Morgan published what appears to be its most comprehensive crypto report to date. It is titled, quote, The Dynamics and Demographics of US Household Crypto Asset Use, and I will leave a link to the full report in the description. Now, the report begins with a short introduction, which gives an overview of crypto adoption in the United States. What's awesome is that the authors refer to crypto assets as crypto, something that you almost never see in these institutionally oriented crypto reports. The authors reveal that almost 15% of the US population has used or invested in crypto, at least according to JPM's data. They attribute this spike in crypto adoption to the pandemic, specifically the resulting stimulus, which led to more investment. The authors also reveal that their data sample includes over 5 million of JPM's customers and reveal that over 600,000 of them made transactions related to crypto. They suspect that most customers lost money in crypto, but that they can't be sure because they can only see fiat transfers in and out. The authors then explain that they structured their crypto report around 3 questions. First, how has crypto adoption evolved over time? Second, what are the demographics of people using cryptocurrencies? And third, how much financial risk did retail investors have? I'll quickly note that the third question is a bit concerning. That's because some jurisdictions have been considering banning retail investment in cryptocurrency. If you watched our video about Federal Reserve Vice Chair Michael Barr, you'll know that this is something he seems to be in favor of in the United States. Anyway, the authors go on to reveal their 4 key findings. The first is that most Americans bought crypto for the first time when prices were spiking. This is not at all surprising, and the authors reveal that the pandemic price pump managed to increase crypto adoption from 3 to 13%. Damn. What's interesting is that the authors used JPM data dating all the way back to 2015 in their analysis. They confirm that they count all transactions to crypto exchanges and platforms as being flows into crypto, and any transactions coming back from these as being flows out of crypto. The authors also explain that they only analysed the most active customers at JPM. Before you ask, most active means any customers who engaged in 5 transactions per month totaling at least $1,000. It's not clear whether this threshold applies to crypto transactions or transactions in general. Regardless, the result is what you see here. Not surprisingly, the number of new crypto users has an almost perfect correlation to BTC's price action. However, I couldn't help but notice that this data is inconsistent with the frequency of Google searches for crypto-related terms, which fell off in early 2021. This suggests that Google's data isn't all that good. But let's not go down that rabbit hole. Now, what's funny is that the authors say that crypto accounts exhibit, quote, herd-like behavior, a comment that made the crypto headlines. To their credit, the authors acknowledge that the same herd-like behavior can be seen in other asset classes, but insist that the effect is more pronounced in crypto. The authors also reveal something extremely bullish, and that's that between 2017 and mid-2022, there were twice as many flows to crypto exchanges than there were back to checking accounts. This suggests that crypto investors are mostly buying and holding. This is consistent with a report by the Bank for International Settlements, or BIS, which found that more than 50% of crypto holders become long-term hodlers. You can find out more about that report using the link in the description. On that note, check out my deals page if you want to make sure that your crypto is being hodled securely. That will also be down in the description. Now, the second finding in JP Morgan's report is that most crypto investors are young, male, Asian, and have high incomes. I can confirm this is accurate, but I wouldn't say that my income is all that high. Jokes aside, the authors point out that this finding is consistent with other crypto reports and surveys. Regarding the raw numbers, 20% of millennials hold crypto compared to 11% for Gen Xers and 4% for baby boomers. Men are twice as likely to hold crypto as women on average, and this is especially true for the younger cohorts. Men also invest twice as much in crypto as women. When it comes to race and ethnicity, the representation is surprisingly equal at around 20% for each group. That is, of course, except for the Asian cohort, 27% of whom have adopted crypto, according to JPM's data. It's not entirely clear why this is, but I reckon it's probably a combination of factors. Anywho, the third finding in the report is that most crypto investors don't invest that much in crypto relative to their income, meaning less than 1 week's worth of pay. However, 15% of crypto investors invest a lot in crypto relative to their income, meaning more than 1 month's worth of pay. The authors reveal that the median amount invested in crypto between 2015 and 2022 was around $600. Note that median is not the same thing as average. The average amount is likely much larger, as averages are skewed by extremes, in this case, very large investments. What you see here is the median amount of money invested in crypto per income quartile. The blue bars are the dollar amount, and the orange bars are the relative income amount. As you can see, richer crypto investors tend to put more of their relative income into crypto. This is where the good old correlation is not causation rule comes in. Some would argue that richer crypto investors put more of their relative income into crypto because they have more money, whereas others would argue that they have a higher relative income because they have more crypto. I reckon it's probably a bit of both. Now, as I mentioned a few moments ago, a small percentage of crypto investors invest a lot in crypto relative to their income. What's wild is that most of these crypto investors fall into the fourth quartile, i.e. the wealthiest, as well as the first quartile, i.e. the poorest. Put differently, the richest of the rich and the poorest of the poor have similar risk profiles, at least when it comes to investing in cryptocurrency. This reminds me of that bell curve meme which shows low IQ people coming to the same correct conclusion as high IQ people, with average IQ people being wrong. As you can see, however, the risk profiles between the first and fourth quartile of earners disappears when you expand the scope of the relative investment. Those in the fourth income quartile are much more likely to invest more than 1 month of their salary into crypto, which makes sense. The authors note that this risk in the fourth quartile, quote, reduces spillover risks because those taking on this risk have higher levels of liquidity in their accounts than those in the first quartile. Now, the way the authors word this suggests they believe crypto should be limited to wealthy investors. At the same time, though, the authors note, quote, individuals with high levels of crypto exposure, on balance, may also have greater ability to bear market risk. This suggests that seasoned crypto holders may be more resilient to volatility, regardless of their wealth. Maybe I'm just seeing things, though. Anyhow, the fourth finding in the report is eerily similar to the first finding, and that's that most crypto investors invested when crypto prices were rising. The difference with this finding is that those with lower incomes tended to get in at the worst possible time compared to those with higher incomes. If I understand correctly, the authors managed to calculate the average price at which crypto investors bought BTC. Most crypto investors bought BTC at an average price of roughly 44k. Richer crypto investors bought BTC at just over 42k, and lower income investors bought BTC at over 45k. Obviously, this means that most crypto investors are over 60% in the red, but the authors caution that this calculation assumes that crypto investors only allocated to BTC. It's more than likely that they also allocated to altcoins, in which case the average loss is much, much larger. What's cool is that the authors calculated the average BTC purchase price not just across quartiles, but across different age cohorts. As always, millennials bear the brunt of the losses, paying the highest average price of any cohort. Gen Xers and the baby boomers weren't far behind, though. Naturally, the authors also found that educated crypto investors got in at a better average BTC price than everyone else, educated meaning having a college or graduate degree. The authors found that this advantage stays even after controlling for all the other factors such as income, ethnicity, and gender. Nice to know that higher education still helps with outcomes. Now, based on flows between crypto exchanges and bank accounts, the authors believe that only around 13% of crypto investors broke even. Only 20% of crypto investors started buying when BTC was below 20k, and almost everyone else bought when BTC was above 40k. Ouch. Now, the final part of the report covers a few of the implications of its findings. Oddly enough, the authors warn that, quote, a small subset of the population may have substantial financial risk to further crypto market declines. This seems to be a not-so-subtle reference to lower-income crypto investors. The authors stress that retail crypto investors in the United States have experienced significant losses over the last year, and tacitly admit that the purpose of this report was to inform regulators and politicians who are, quote, concerned with investor protection. The authors explicitly single out lower-income investors as being at risk and claim that crypto may, quote, merit a differentiated policy approach to, quote, protect investors and the economy. Now, call me crazy, but I'm pretty sure that JP Morgan is calling for crypto to be restricted to accredited investors. That's code for rich people, by the way. Then again, the megabank may just be calling for there to be a test of competence before retail investors are allowed to buy or sell coins or tokens. Fun fact, this is a policy that was being pushed by FTX and Alameda Research founder Sam Bankman-Fried in his crypto regulation recommendations. More about those in the description. Thank God that guy is finally behind bars. Now, in JP Morgan's defense, it's easy to understand why crypto would be a concern to existing institutions. Beside the fact that the megabank can see that money is moving out of its accounts and not coming back, the adoption of crypto during the previous crypto cycle was truly unprecedented. Recall that the percentage of crypto holders spiked from 3% to over 13% since the start of the pandemic. If we see another 4x spike in crypto adoption in the next cycle, that would translate to a crypto adoption rate of almost 60%, at least in the United States. This would make crypto a very large asset class, one that could unironically be large enough to lead to financial stability risks. The thing is that the financial system is supposed to be resilient to shocks. However, the financial system has only become less resilient as it has become more centralized. This brings me to the big question, and that's what JP Morgan's report means for the crypto market. Well, I suppose that ultimately depends on whether it lands on the desk of a US regulator or politician. From where I'm standing, it looks like that's who this report is really directed at. As I mentioned a few moments ago, megabanks like JP Morgan aren't happy about crypto adoption because it's basically cutting them out of the financial equation. Some would say that their calls for crypto regulations are an attempt to slow this down, but even they know crypto adoption is inevitable. That's why JP Morgan and other wolves on Wall Street have been aggressively investing in crypto over the last 2 years. They are hoping that they can preserve their future profits by acquiring and controlling key players in the crypto industry, be they crypto companies, crypto protocols, or crypto projects. If you watched our video about ESG and cryptocurrency, you'll know that the inability of institutions to control BTC is a big part of why they bash it so often. At the same time, they're actually fans of BTC precisely because it can't be controlled and has a similar profile to gold. This is evident in JP Morgan's own opinions. Unfortunately, the same can't be said for proof-of-stake currencies, many of which could theoretically be taken over by a large bank or asset manager at a moment's notice. Make no mistake, there is a huge incentive for these entities to control what are effectively going to be the future payment rails. I mean, by this point in time, it should be obvious to everyone that crypto isn't going anywhere. The only debate is who will, or rather, who should, control these cryptocurrencies. Should it be the government? Should it be the central banks? Should it be the asset managers? Or should it be everyday people? In theory, everyone should have a stake in the system, but again, in practice, each entity has an incentive to take as much of the pie for itself as possible. Now, as silly as it sounds, the most important aspect of this competition will probably come down to which of these entities has the hardest diamond hands. To my mind, calling for aggressive crypto regulations is nothing more than an attempt to crack the diamond hands of retail investors who adhere to the core values of cryptocurrency. After all, the result of all this so-called consumer protection is that prices crash, and I don't think that's a coincidence. In sum then, JP Morgan's crypto report reveals that it and other institutions in the traditional financial system are starting to get nervous about the rate and resiliency of crypto adoption. There's no doubt that this is extremely bullish, but it's going to take a long time for this bullishness to be reflected by crypto prices. And now that this video is at an end, you can find out when the current crypto bear market could end by using the link in the description.